Well, oil prices have dipped on news of the deal, sitting just over $80 a barrel. The cost of Brent crude hovered near $120 a barrel at its peak in April, driving up costs around the world and prompting many countries to bring in emergency measures like slashing fuel taxes. Well, Seb Kennedy is an independent energy analyst and founding editor of Energy Flux. That's an independent intelligence platform covering gas and LNG markets. He joins us live from San Jose in Costa Rica. Seb, so what do you make of the Iran deal and how will it be received, do you think, by the energy markets?
Yeah, well, there is no deal, and a lot of your previous speakers have spoken at length about how this is very much a kind of tentative step towards what might become a deal. However, what's been notable since the outbreak of the conflict is that markets have been extraordinarily eager to take at face value any pronouncements from Trump and the Trump administration around the possibility of a peace deal coming. So really a lot of the downside in prices has already been priced in. What that means is that when both sides roll up their sleeves and they sit face to face at the table to try and hammer out a negotiated deal, and all the obstacles come to the fore around nuclear program, around how to deal with proxies, around the unfreezing of assets, and we reach the end of that 60-day negotiating period. If they start to realize that actually we might run out of road and there is no lasting peace deal, then they'll have to price in the likelihood that Iran will take control of Hormuz again at the end of that 60-day period. So we're going to enter an extraordinarily volatile period for energy prices, as there's a war of words to control the market narrative and the sentiment, which has been a war that's continued beyond the kinetic action that we've seen after missiles flew in March.
Yeah, and just talk us through, Seb, how the war, just remind us of the whole timeline, how the war has impacted markets and supply chains, and more importantly, the pricing of oil and gas.
Yeah, absolutely. Well, it's been quite surprising, really. I focus on gas and LNG markets in Energy Flux, and we saw prices on, for example, the Dutch TTF, which is the European benchmark gas price, shooting up to sort of 60 euros per megawatt hour, which was a price that was like kind of a many months record high price. Many people expected it to continue accelerating and reach higher levels, but it didn't. It sold off consistently throughout the conflict as there was this kind of jawboning of the market. So Trump trying to kind of coax commodity prices back down again to ease the political pressure at home, and I think a lot of the investment funds who take positions in gas futures were burned by this. They took out bullish bets in TTF futures, expecting the price to go higher, and those bets didn't pay off. So now they're very cautious about opening new bullish positions and about betting on the price going higher. Even though the fundamentals might justify a move higher, they're very cautious about actually placing those bets because they've been burned once and they don't want to get burned again.
Yeah,
but like I said, we get. Go on.
Yes, Seb, I was going to say that even if the Strait of Hormuz reopens on Friday, they still have to clear, we've been talking to our guests about it tonight, they still have to clear the mines, there's a backlog of ships and product. That's a huge task. It still means that supply chains are degraded. Is that priced into the markets?
I don't think it is, and that's been one of the most perplexing phenomenon of this conflict, is that the fundamentals have been pointing towards a very kind of bullish, tight market scenario, and markets have been just very reluctant to price that in. So like I said, when we get to these knotty problems about the reality of opening up the Strait, and that's only the kind of the very first stage, having cleared the mines, which could take weeks, if not months, then you have to restore flows. And that, again, has a lead time of weeks, if not months. And so the question is, at what point do markets really start to price in the reality, the physical reality of the markets, which they've just not been very willing to do, it seems.
And Seb, just a final thought to you. Remind us again how this war has affected big regional gas and oil suppliers like Qatar, for example, because Gulf countries have taken a huge hit, haven't they, both in terms of infrastructure being hit and the inability to get oil and gas out.
Yeah, Qatar is the most exposed, and of course they did take direct missile strikes on two of their mega liquefaction trains in the Ras Laffan liquefaction complex. And so those trains are out of service for between 3 and 5 years. That only represents a portion of their liquefaction capacity, and they've actually been very eager to not only accelerate the repairs of those, but also to continue and accelerate they have a mega expansion project that was supposed to come online this year or start to come online maybe next year. They've been keen to actually accelerate the expansion of their liquefaction capacity, even with Hormuz closed. So they are very optimistic about the ability to export large volumes of liquefied natural gas. But none of this expansion is going to be able to do what it's supposed to do if Hormuz is closed. So there's a lot riding on